Good morning, happy Friday, and welcome to this week's episode of Sunrise Small Talk. A little bit of a special episode. We're going to be out of order, but I thought it was going to be important for us to talk about the economy, policy, and markets. So, we're going to go through a few things here. We're going to talk about number one, just what does the economy look like? Market pullbacks. Are we in a normal phase right now? Is it something to be cautious about? And then we're going to talk about the Fed, because as I have always said, the Fed is going to be the biggest driver of an economy and market performance. And finally, we'll dive into a little bit of SWOT analysis. For those of you with a business world, business background, you understand SWOT, SWOT, strength, weaknesses, opportunities, and threats. And then we will dive into some portfolio edits and changes that the Carson Investment Research Committee has made. With the disclosure that the best source of information for your changes is looking at your statements from your custodian, Charles Schwab or Fidelity, and none of this is a recommendation or a solicitation, just simply informational. So with that, let's dive in. Okay, real quick before we dive in, a couple upcoming sunrises and videos that I'll be putting together. Number one, 7 tips to transfer effectively and efficiently your wealth to your kids. That will be accompanied with a PDF. Next, we're going to have power of attorney. When, why, who should you pick for your power of attorney? And then RLTs, revocable living trust, revocable trust. It has a million different names, but we're going to talk about the components, who's part of that, pros and cons of having one in your financial plan. So let's dive in. This is going to be a little bit longer of a sunrise because there's a lot of important content. I'm going to start with the end. I'm going to read you the last page of the book, and then we will backfill. So number one, starting with the end, portfolios. As I mentioned in the introduction, your portfolio may look different. So check your own statements. That's the best source of information. We also send you an email every time a trade is made in a model that you own. That will come to you via email, and then we'll talk about the rationale behind it. If you're not getting those, which you should be, but if for whatever reason you accidentally unsubscribed at some point, let us know, and we will make sure you continue getting those very helpful emails. Okay, let's dive into the portfolio. And what I'm talking about here is just kind of our unconstrained views. So we do have models that have to stick to a benchmark, and there's not a lot of deviation. But overall, these ideas I'm going to talk about are just more the unconstrained, what are we thinking within the Carson Investment Research Committee. And number one, I think the best way to explain this is when Marlo and I go check the mail, we have the destination of the mailbox in mind. I take the sidewalk, nice straight path. Marlo takes the most ridiculous path possible to get to the mailbox. And our overall baseline view of the market hasn't changed this year, but how we're going to get there has changed a little bit. We do see more risk. There's been a lot of policy implementation. Obviously, you're seeing headlines. Market's up 600 one day, down 600 the next day. There's just a lot going on, a lot of surprises and a lot of unknowns. We still think we're going to have a nice double-digit year. The path we take to get there could just look pretty different. So what are we doing to address that? Number one is just reducing equities overall. Again, I'm talking unconstrained portfolio here. We're about 85% equities in this portfolio, which has been high, and that is still high. We still are very confident in the equity market, but this has been reduced a little bit down to 76%, so a little reduction in equities. And what does that look like? So, and where is it going? Number one, have had a reduction to small cap and mid cap. Some of that money has gone to, and overall in equities, we still have an overweight to domestic US equities versus international equities. There's a lot of headlines over in Europe going on right now as well. Where is it going? It's going to actively managed cash account. So it's not sitting in a cash account like you'd see at your bank where you're getting, $1 a year or something like that. It's actively managed, so we are trying to generate a little more dividends and interest, but just a little way of taking some money off of the table. All right, diving back into this because there was an important piece of portfolio componentry that I wanted to discuss, and that is the relationship between using what we call low volatility versus momentum investments. So low volatility are exactly what they say. low volatility. When the market is going crazy, they will move, but not as much as the market as a whole. Momentum is the complete opposite of that. Research shows that if you mix the two, you can increase the result of your portfolio outcome. So what do I mean by that? This is going to be the S&P 500. It sort of lives in the middle. Over here is low volatility. Up here is momentum. This is our risk, and this is our return. Without getting too technical here, what you are trying to do is go up and to the left in your portfolio. So if your portfolio is the S&P 500, it's right here exactly even with the S&P 500. But what you can do is remove S&P 500 funds from your portfolio, replace them with low vol and momentum. You're effectively creating the same thing, but what that can do is move your portfolio up and to the left. If it moves to the left, that means we reduce risk and volatility, but we're still getting the same return. If we move it upwards, that means we increased our return without increasing our risk in our portfolio. So ideally, we want to go up and left, which is reducing our return. Sorry, I don't want to reduce your return. Why would I want to do that? Reducing your volatility while increasing the return. And this is something that we have implemented into our models to help get this up-left movement in portfolios. Now I'm going to backfill where all this comes from, because you may be thinking one of two things. Number one, I love what's going on and I think the market's going to crush it. Or you may be thinking this is terrible, we need to sell out of everything. Obviously, if you work with me, neither of those routes are the route that we're going to go, because we don't let headlines drive our investment decisions. I'll say it again, we don't let headlines drive our investment decisions. You're going to see a lot of headlines this year. Don't let those drive your decisions, because you'll end up making mistakes and having worse portfolio performance than if you just let things ride out. So let's talk about kind of market charts as a whole. So number one, volatility Q1. You have some glares from the windows. This is January to December. Volatility Q1 and market performance Q1 of the first year of a presidential election does kind of hang out here. And then we see this. It's something like an average 8% return. I don't know. You'll have to fact check me on that. But typically we see some volatility Q1, and then the market increases from that point. Additionally, we have a chart that looks just like this, and rather than first year of a presidential election cycle, it is the year coming off of a year where the market gained 20% or more. Same thing, a little choppy in the beginning, and nice double-digit return on average from that point going forward. So what we're seeing right now is normal. Again, has not changed our overall views of where we're going to be at the end of the year, just has changed how we're going to get there. Number two, I think pullbacks are very normal. If we look at 3, 5, 10, 15, and 20. Okay, these are my pullbacks, and here's how often they occur. 3%, 5%, 10, 15, 20. This is basically just daily volume. Maybe it was a bad week, all the way to we are in a full-blown bear market, and that sun is in my eyes. Off the top of my head here, we have 3% pullback something like 7 times per year, so that's pretty normal. A 5% pullback is going to be something more like 3 times per year. And as we go down, again, I don't know these numbers off the top of my head, but what I think is important is these happen all the time. There are a lot of them. As we shift down, a full-blown bear market, which is classified as a 20% or more pullback, happens about every 3 years. So 3% of the time, every 3 years. And we're about every 2 years on the 15% pullback here. So that's important to keep in mind, that what we're seeing is very normal. Want to talk about a little bit about SWOT analysis here. I'm running out of space, but that's okay. SWOT analysis: strength, weakness, opportunities, threats. So what do we have as far as strength? Well, we have a strong labor market, number one, and we have Household balance sheet and consumer debt. I know people like to argue with me on this one, and I kind of would argue with myself based on what I see out there in the world. Balance sheets are strong. Household debt is low. That's a fact. You can look that up. It may not feel like it, but that's true. So those are some of our strengths. Weaknesses: housing, high interest rates, mortgage rates hanging around 7% still. So that just causes a little bit of pullback that we've seen for really the last couple of years in housing. Tell you what, I'm not selling my home anytime soon because it has not made hardly anything since we purchased it back in 2021. Opportunities: easier Fed policy, but we're not going to know that probably until the second half of the year. So another component of what I want to talk about is the all-important Fed. What is the Fed doing? Well, we still expect 2 to 3 rate cuts this year. They're just not going to happen anytime soon. Fed drives economies and markets. There's too much uncertainty, so the Fed at this point is just like, we don't know, we need to see how things shake out. So hopefully back half of the year, we'll get some rate cuts that will certainly boost markets. I guess I can't say certainly, that's not allowed. Historically speaking, that would boost markets. Okay, so opportunities, Fed policy, looser regulation, and threats. Obviously, threats there, we have a lot of unknowns when it comes to tariffs, and we have unknowns when it comes to tax policy. If we look at President Trump's first time around, major tax cuts went into place, followed by tariffs. So that was great news, followed by bad news, and the market reacted as such. Ultimately, the market did well in 2017-18 as those tariffs were released, but that was coming off the heels of a more favorable tax policy. There is no room for taxes to go down at this point, so the news we're getting is not about tariffs, is not going to be accompanied by positive news. Now, when it comes to the thought of, okay, tariffs are going to cause this temporary market turbulence. We saw that in 2017, 2018. Is it a concern? Is it something you should be worried about? The answer is, if you're pulling out all your money right now or in the next month or two, then yeah, you should absolutely be concerned, and you should probably be making some conservative changes to your portfolio. And that's 0% of you. So I say that kind of as a little bit of a joke because that's nobody. We're all long-term investors here, so we're not going to make significant changes other than what I mentioned about how we are reducing equities in some of our models and are making some shifts, but it's not like something where we're going to cash out. We're not going to try to time the markets. Pause there and I'll say it again. We're not going to try to time the markets, but we will make some minor allocation changes. So going back to the Fed, one thing that I think is important to understand is tariffs, typically they can be inflationary, and it's not necessarily inflationary because inflation is a long-term reset, whereas tariffs are going to be more in the short-term camp. You also have tariffs will typically increase the strength of the dollar. We haven't seen that recently, but typically that's the way that works. So your dollar is stronger. Tariffs can cause price increases because someone has to pay for that, whether that's us as the consumer or the supplier. We don't know. It's probably going to be some split between the two. But you have prices going up and you have a stronger dollar. So really, this is not my analysis. This was actually from one of the Fed board members. I forget which Fed branch, but one of the Fed branch members said, while you do have this increase in price, you also have a strengthening dollar when you're just talking about tariff policy 101. So do those things offset? He says yes, that they do. We'll see how this all shakes out. So I think with that, is there anything else I want to go over? Sure, probably so, but we'll just cut it at that. Watch out for the upcoming Sunrise Small Talks. Have a great Friday, great day, and we'll talk to you soon.